You're sitting on a fence between two choices that feel almost the same. You have a gold ETF or physical gold in your vault. The same metal, right? The same protections. The same inflation hedge policy. But there is one thing nobody tells you, and I mean financial advisors, securities, firms, and even some precious metals traders. In March 2026 alone, gold ETFs evaporated about $11 billion, and most investors did not know this could happen. At the end of the video, you'll understand why this is happening. You will see that the specific counterparty risk is obviously hidden in ETF contracts. You'll find that the cost of insurance actually weakens your return on real gold, and these costs are almost never discussed. Most important, you will have a practical framework for making the right choices for your portfolio. Not what some commission-hungry advisors want you to buy, but what really suits your situation. Look, we're at an interesting moment in 2026. In January this year, gold just hit a record high of $5,608 an ounce. A record high. Naturally, millions of investors began to ask the same question. How do I own this thing? What is the difference between when I buy physical goods and when I buy ETFs? On the surface, the answer seems simple. Gold is gold. Whether you are in your brokerage account as an ETF stock or locked in a vault, you have exposure to gold and are hedged and protected. But that is where things get dangerous. Here is what actually happened in March 2026. $11 billion disappeared from gold ETFs in a single month. As some market analysts began to call it, this is a huge outflow of gold, and the absolute big names State Street and BlackRock, which manage these funds, have also experienced a large outflow of funds, impacting the gold mining industry. Most retail investors don't know what happened or why. This is not a theoretical risk. That happened 4 months ago. Yes, it was sudden. That caught many completely off guard. That is why it is important now. You have to choose between these two models, and there are huge differences between them. You need to know what you're really signing up for. You need to know the hidden risks. Not the superficial things your broker is talking about, but the real risks, all of which I'll show you today. Before entering the ETF and physical split, let us first determine the current actual position of gold in April 2026, because understanding this will change everything you decide. Gold closed at $4,567 an ounce in April, down from its January peak of $5,608, but still 41% higher than a year ago. This is not coincidental or random market noise. It is important for you to understand the actual structural drivers driving gold higher, because they directly affect which choices make sense for your portfolio. The first driver is central bank buying, which is significant in ways most people don't realize. Global central banks now own nearly 36,200 tons of gold, or about 20% of their official reserves. Just a few years ago, that was about 15%. That is a 5 percentage point change that sounds small, but represents hundreds of billions of dollars flowing into gold. JPMorgan. This analysis here is important because they expect the central bank to buy about 755 tons in 2026 alone. That level is still rising from levels before 2022, when average annual production was only 400 to 500 tons. What we call central bank purchases is about 50% higher than historical normal. The second driver is geopolitical instability. The situation in Iran, tensions in the Middle East, potential damage in the Strait of Hormuz. These things are important to gold prices because gold is a safe haven when there is uncertainty about what monetary security and what asset security are, and always have been. The third driver, also interesting, is what JPMorgan calls rebalancing theory. If only 0.5% of us foreign assets were converted to gold, that would be enough to push the price to $6,000 an ounce. We're not talking about large-scale policy shifts. We are talking about a modest portfolio adjustment, when major institutional investors currently hold only about 2.8% of their total assets in gold. Historically, the rate has been as high as 4 to 5%. There is structural room for operation. Now it is your decision. Both ETFs and physical gold benefit from these same drivers. They are all taking advantage of the same trend. The question now is not whether gold is a good hedge. The question is which car is best for you, given the specific risks we're about to cover. Well, then you decide to buy a gold ETF, open your brokerage app, search for the 2 largest GLDs or IOCs, and then click buy to hold the stock immediately. Here is what you think you own. Gold, physical gold, sitting in a vault, one-on-one backing your stock. Here is what you actually own. A share in a fund that is contractually obligated to hold gold for you. This is a completely different thing, and the difference is important. Let's start with the major gold ETFs, because you need to know what is really robust and what is really problematic. Spider Gold Stock GLD is the largest, with assets of about $64 billion. GLD, first introduced in 2004, is backed by physical gold held in HSBC's London Vault. You spend 0.40% a year. Of the $100,000 investment, you pay $400 a year for the privilege of owning an ETF. On the face of it, that sounds reasonable, but we'll go back to that in the cost comparison. There are also IAU and eShares Gold Trust, with about $29 billion in assets and physical gold backing, but they spread their holdings into vaults in Toronto, New York, and London. The rate here is 0.25% per year, lower than GLD, which is one of the reasons some investors like it. Then there are SGOL and Aberdeen Standard Gold ETFs. This is interesting because it has the lowest cost rate, 0.17%. Now 0.17% and 0.40%. Don't sound very different, but in 20 years of math, the difference of 0.23% is equivalent to 4 to 5% of the total return. It really matters. All of this has physical backing. They actually own the metal without buying futures contracts or other oddities. They hold physical bars certified to meet the good delivery standards of the London Gold Market Association. But that is where it gets tricky, and where most people's understanding completely collapses. When you own a gold ETF, you don't own gold. You own shares in a fund that holds gold. Between you and gold, there are a pair of trading bracelets you need to know. Let me break it down because it is important. First, the fund issuer. This is GLD's State Street, IAU's BlackRock. These companies have a responsibility to hold your gold, but they could go bankrupt. Yes, even these sprawling institutions. In 2008, Lehman Brothers became the 4th largest investment bank in the United States, plunging overnight. The second is the main custodian. This is the entity that actually holds the physical metal. For GLD, this is HSBC. For IAU, this is a number of institutions. Those custodians were supposed to be very stable and safe, but they still have counterparty risk. If HSBC has serious financial problems or the British banking industry is subject to some kind of political interference, these are low probability events, but they are real possibilities. Third, there is a custodian. These banks and vault operators help manage metals in different locations. This is where the problem gets complicated. The more entities in the chain, the more points of failure. CSE Rule 17 CFR vertical bar 275.2064. 2 requires the fund to withdraw assets if the sub-trustee does not meet the criteria, but there is a transition period and your gold is in a state of uncertainty. This is the counterparty risk I mentioned at the beginning. This is not theoretical. Yes, this is systemic. That risk becomes important during crises, like a banking collapse or geopolitical shock. Here is what happened in March 2026. The market became unstable, and investors began asking me if my ETF was really safe. They all started pressing the sell button at the same time. That led to an outflow of $11 billion. ETFs have had to liquidate their holdings and share prices have fluctuated. At that moment, people realized I couldn't just walk into the vault and get my gold. I had to sell my shares. If everyone sold at the same time, I would lose money. This is a liquidity risk disguised as security. Under normal circumstances, ETFs are highly liquid, with millions of shares trading every day. But during the stress, liquidity evaporates. Bid-ask spreads expand. Trading volumes dry up, and suddenly your liquidity investment becomes difficult to exit. Another key problem with gold ETFs is that if you are a retail investor, you can't actually convert stocks into physical gold. Only institutions known as authorized participants, big financial firms, can do that. You're stuck selling in the secondary market. If the secondary market is frozen, you are frozen. There is also a drag on cost rates. Yes, 0.17%, 0.25%, 0.40% don't sound like much. But look at the actual math. If gold prices rise 5 to 7% a year, JPMorgan Chase expectations for 2026, and you lose 0.25% to 0.40% due to expenditure, 4 to 8% of your potential annual earnings will be eroded. 10 years later, that is the difference between comfortable retirement and having to work a few more years. Most gold ETFs track spot prices. Well, but good is not perfect. A slight drag on cash and a slight delay in rebalancing contributed to the decline. In short, for most major ETFs, the tracking error is still small, less than 0.5% a year. But it is true. When you combine it with cost, you give up real money to own the car. Finally, there are regulatory and operational risks. If the SEC changes its rules on the structure of ETFs, or if some custody requirements become more expensive, or if funds become uneconomical and have to close, you will get cash in liquidation, not gold. The timing of cash payments can be bad. Well, so you decide to take the physical route. You want to have a real gold bar or coin, no counterparty risk, and then you have it. It is simple, right? The problem is, it is actually much more complicated than the ETF route, much more expensive than most people realize. Let's start with acquisition costs. You want to buy gold bars, so go online or to a local dealer, and spot gold is now around $4,567 an ounce. But traders don't sell you gold at spot prices. They added a markup. It is usually between 3% and 5% above the spot. Let me give you some numbers. If you want to buy 100 ounces of gold, about $456,700 at current spot prices, an increase of 4%, you can buy the metal for another $18,268. This is non-negotiable. Every dealer does it, and that is how they keep their business going. Then, depending on where you buy and local regulations, you may face a sales tax. Some jurisdictions do not tax precious metals, while others do not. It is a mess. Now the metal is with you or the dealer, and that is where real costs are starting to hit hard. Warehousing and insurance. This is where physical gold has become very expensive. I mean very expensive. The first act is you leave it at home. You buy a safe. Where do you hide the bar? The theft risk you face now is not theoretical, but real. If someone breaks into your house and you have $450,000 worth of gold, it is gone. Insurance does not cover it because your homeowner's insurance policy is limited, and precious metals are usually capped at $1,000 to $5,000. You need an extra rider, and it is not cheap. The second is to use a bank safe. Of course, you get better security, but your insurance costs more, not less, because the bank passes the blame on you. In addition, you can only access it during bank hours, which is the liquidity limit you need to consider. Scenario 3 uses a professional vault. This may be the best option if you want to be safe, but it costs money. $200 to $500 a year, depending on vault, location, and storage. In addition to storage, there is insurance. That is the point. The cost of insuring physical gold is 1 to 2% of its value annually. So in our $456,700 investment, LLC annual insurance costs between $4,567 and $9,134. Let's calculate how much you actually spent: $200 to $500 for storage, plus $4,567 to $9,134 for insurance, or $4,767 to $9,634 a year in book costs. This is equivalent to 1.0% to 2.1% of the total value of gold you hold each year, compared with 0.17% to 0.40% gold ETFs. ETFs are actually a quarter to a sixth of the annual cost. Here, it is a serious matter. The book cost of physical gold has totaled $47,670 to $96,340 for more than a decade. This is equivalent to 10 to 21% of the total initial investment, with no return. With ETFs, you spent $1,716 to $4,000 in the same period. But wait, there is more. When you finally want to liquidate physical gold, you run into problems. You can't just tap a button on your phone and sell it right away. You have to find buyers, usually traders, and arrange for them to test gold repeatedly. If they don't trust the certificate of authenticity, the test costs $20 to $150 an ounce. Then you negotiate a price and wait for the payment to settle. Throughout the process, the gold market can be bad for you. If prices fall, traders will widen the bid-ask spread. They'll give you less. You will have to accept worse terms because you need liquidity. For gold ETFs, the whole process takes a few seconds. One click. Market price execution. Done. Physical gold now carries another risk, often considered too late: purity and certification. Really, fake gold bars are in circulation. They are complicated. They are getting better. If you buy physical gold from an unknown source, or if you inherit gold without proper documentation, you are at risk because you actually don't know if this is true. If it is not a good delivery standard for LBMA, it means that it was cast before 2019 and does not meet LBMA specifications. It must be melted and recast, which is expensive. This is actually the problem that Gold ETF solves for you. Each ounce of gold in a major ETF has been independently verified by auditors to meet LBMA good delivery standards. Audits are conducted annually. Gold is certified. There is no risk of fraud. One more thing about physical gold is quietly killing many people's earnings: traders' liquidity spreads. When you buy gold at $4,567 an ounce from a trader with a spread of 4%, the trader makes only $183 an ounce. When you go and sell it back, the same dealer may give you only $4,385 an ounce. It was another 4% cut. So to get your gold in and out, you sacrifice the spread cost of $366 an ounce. 100 ounces is $36,600. That is 8% of the round trip fee. By contrast, YLD's bid-ask spread is actually 0.01%, a basis point. That is 60 times less than you pay the dealer. So let me summarize the actual cost of physical gold over time. Buy 100 ounces and hold for 10 years. Acquisition markup of $18,268. Annual storage of $2,000 to $5,000 over 10 years, equivalent to $20,000 to $50,000. Annual insurance of $45,670 to $91,340. Sales spreads and fees exceeding $36,600. Of your $456,700 investment, your total cost is $120,538 to $181,208. That is, 26 to 40% of your capital is spent on fees, costs, and spreads. In contrast, a $456,700 gold ETF investment, which is bought at market price, has an initial cost of zero, an annual fee rate of 0.25%, equivalent to $1,142 a year, a 10-year cost of $11,420, and a selling spread of about $50 or 0.01%. Your total cost is $11,470. That is 2.5% of your capital. The difference is striking. That is why the industry hides such comparisons. If everyone knows that everyone will buy ETFs, there will be no market for physical gold sales under these spreads. The retort you'll hear now is that, at least for physical gold, I own it completely and have no counterparty risk. That is partly true, but the risk profile is different, not better. Yes, you eliminate counterparty risk, but it increases security risk, liquidity risk, and certification risk. You're trading one set of questions for another, and you're paying a huge premium for the deal. Well, we've covered the obvious risks, but there are some deeper risks that most investors just don't see, and if you don't pay attention, they may deceive you. First, in March 2026, population outflow was still occurring. The $11 billion outflow from gold ETFs is not one time. When gold began to fall to around $4,567 from a January peak of $5,608, many investors panicked when they saw earnings shrink and pressed the sell button. What they don't realize is the impact of selling pressure on ETF liquidity and pricing. When there is large-scale redemption pressure, authorized participants, institutions that create and destroy ETF stocks have to sell physical gold in the spot market. That further depresses prices. This is a negative feedback loop that hurts retail investors who are selling to weakness. This is actually a key insight. ETF selling can accelerate price decline in a downturn. This is the opposite of the liquidity market you expect. Second, the demand of the central bank began to burst. JPMorgan Chase expects central bank purchases to be about 755 tons in 2026, which sounds strong. But look at the actual data, down from more than 1,000 tons in 2025. Why? Because gold prices are now so high, the central bank can buy a few tons less to achieve the expected proportion of gold allocation. What if the central bank really starts selling gold? Or if a large reserve holder decides to rotate gold? That changed the whole argument. This is not impossible because the geopolitical situation changes, policy changes, the central bank can change its mind. Third, ETF demand is collapsing the way you should worry. In the first quarter of 2026, the demand for gold ETF was only 62 tons, 229 tons in the first quarter of 2025, down 73% year-on-year. This tells you a real thing. Retail and institutional investors are losing confidence in the ETF structure. Instead, they turn to physical gold and bars. Data show that demand for gold bars and coins surged 42% in the first quarter of 2026. People are leaving ETFs. Why is this happening? Perhaps because of the March exodus. People saw what would happen when hundreds of billions of dollars poured into exports at the same time. They realized that during the crisis, my liquidity investments were actually less liquid. Fourth, regulatory risks are real and cannot be ignored. The SEC could change the rules governing ETF custody. LBMA may change good delivery standards. The Fed may introduce new rules. Any of these factors can make ETFs more expensive to operate or create friction in the system. For example, if the CSC decides that all gold ETFs must use multiple independent trustees rather than a single custodian, this will increase costs and fees, which may jump from 0.40% to 0.60% or more. For large ETF holders, that is a multi-million-dollar premium. Fifth, authorized participants may cause price dislocation and harm ordinary investors. It works like this. If the authorized participants decide not to create new shares in the ETF because it is not economically attractive to them, or because of their own liquidity problems, the ETF can trade at a price higher than its net asset value. That means You can buy $100 worth of gold for $105. This is rare under normal market conditions, but it happens under pressure. If you are forced to sell an ETF premium trading, you lose the premium. And when the callback comes, you are the person holding the bag. So, what is the right choice between physical gold or gold ETF? The honest answer is, it depends. But here is a framework for solving the problem once and for all. If the intermediate time span is 5 to 15 years, choose gold ETF. Or if you invest more than $50,000. Or if you want real liquidity and the ability to exit quickly when needed. Or if you're willing to trade some counterparty risk for lower costs. Or if you live nearby, there are no good physical gold storage options. Or if you don't want safety, insurance, and logistics above all else. Or if you understand the risks we underwrite and knowingly accept them. Or if your primary goal is wealth preservation, not doomsday insurance. In this case, if you want the cheapest option, use Sugal at a cost rate of 0.17%. If you want to better balance size and cost, you can also choose 0.25% IAU. If you invest less than $10,000 and the percentage charge is less important in absolute terms, choose physical gold. Or if you can get good vault storage through professional facilities instead of a home safe. Or if you're willing to accept lower liquidity for real ownership. Or if you hold it for more than 20 years, you can arbitrage. Or if you're building a real disaster insurance portfolio for extreme situations. Or if you ignore the rules of traders, price increases and spreads. Or if you understand the tax implications and plan for them, here is what many sophisticated investors actually use. Your situation is worth considering. 80% of ETFs are used for core holding, which can be easily rebalanced due to low cost and high liquidity, and 20% of the physical goods are used for the actual storage of professional vaults. Small enough that arbitrage costs don't hurt your returns, but big enough that you have what you really have. This gives you the cost efficiency of ETFs and the catastrophic scenario of preventing the financial system from being damaged in ways we can't predict. One more thing. Whatever you choose, understand the difference between gold as a return generator and gold as an insurance policy. If you want a 10% annual return, you'll be disappointed with both. The historical yield on gold is inflation plus a real return of 0 to 2%. That is it. You shouldn't get rich fast. It should protect wealth and hedge against currency depreciation. If that is what you want, both cars work. The question is, which car has less friction and can take you there? Look, I gave you a lot of data in this video: price charts, counterparty breakdowns, cost comparisons, risk matrices. Here is what I want you to actually use. First, determine the actual use of gold in your portfolio. Insurance or return-generating assets? This decision determines everything else in your strategy. Second, do math problems according to your situation. If you invest $100,000, the cost difference between a 0.17% ETF and a 1.5% actual book cost is about $1,300 a year. That is the real wealth of decades in your exact amount. Third, don't just blindly follow the advice of some consultants. Ask them to justify the cost. If they recommend ETFs, ask them specifically about counterparty risk. If they recommend physical transactions, ask about their book costs. If they give you vague answers, find another advisor. Fourth, think about the direction of the financial system. Physical gold makes more sense to you if you really think we're heading toward some sort of systemic collapse, with counterparty risk becoming extreme. This is a reasonable view, but if you think the system will muddle through as usual, ETF is mathematically the best option. Fifth, remember that the March 2026 exodus was not a disaster. This is a function to show the actual operation of the ETF system. Large-scale redemptions are carried out in an orderly manner. Prices remained relatively stable. This actually proves the integrity of the system. Make a rational decision and stick with it. Don't check your portfolio every day because it kills your returns through emotional decisions. Let it compound over time. Because in the end, gold is gold both in ETFs and in vaults. If you have mastered the time frame and discipline, the car is almost a second exposure. Thanks for watching. If the frame helps, click a similar button. If you want to delve deeper into important financial topics, subscribe. If you have questions about your specific situation, please comment because I have seen it and I will answer the good questions. Don't believe me? You need to do your own research. Enhance JPM's report. Read the LBMA standard. Check your rates on eShares or State Street. The information is public. Homework is up to you. See you next time.